Morgan of SunWest Mortgage is here to change the world of loan originations forever. From sending updates to your clients to allowing you more time, you can do it all in a simple chat. You no longer have to struggle with documents. All you need to do is select the files and upload them, and they're submitted in an instant along with your loan file. With SunWest, your true home is always within.
Welcome to The Interest. I'm Katie Jensen. Sometimes it feels we take one step forward only to go 10 steps backwards. That's what's happening with trying to increase the number of mortgage loans to Black people and other minorities. But there are some lenders that are worse at it than others. And the National Community Reinvestment Coalition is calling out one after years of working with the bank to improve. The NCRC says KeyBank engaged in redlining in several major cities and decreased lending to low and moderate income borrowers. And the coalition is severing ties with the bank. In a report released Thursday, the group says they broke faith with a community benefit agreement signed in 2016. In a statement, KeyBank says between 2018 and 2021, they increased loans to African American borrowers by 24%. And its lending to low and moderate income borrowers outpaced national lending averages. The bank also says it committed $25 million to increase mortgage lending in majority minority neighborhoods. The NCRC says that's not what its research found. The group says only 2.2% of KeyBank loans in 2021 went to Black borrowers. This ranked dead last among the top 50 lenders. And across 14 of the 20 markets where KeyBank reported the most originations in 2021, it trailed the rest of the top local banks in lending to Black borrowers. In 6 of those markets, other banks' share of loans to Black borrowers doubled those reported by KeyBank. KeyBank says even though NCRC decided to step away from their partnership, it will follow through on targeting $40 billion in investments in these communities. But Black customers say they have a hard time trusting banking institutions because of things like this.
My generation and generation under me, and we read these headlines like it's 1969 sometimes.
Unfortunately, higher denial rates are one of the many challenges for Black homebuyers. Some can't even get this far because they don't meet traditional credit evaluation used across the industry. And many of these underserved borrowers can't afford homes. So how do we help them get a mortgage? Our own Mike Savino gives us a look at ReadyLife, a new fintech company trying to help people build credit profiles.
It's not rocket science. It actually just makes sense.
The lending industry is rethinking how it evaluates credit risk with a focus on moving away from the traditional credit score model. ReadyLife launched in September and says it has a way to do that.
We're a bank-in-the-box sort of platform that has a very strong and defined mission.
ReadyLife is a fintech banking platform that helps people who are underserved and unbanked build a credit profile. The company uses information like a customer's rent history and cash flow over time.
Some people that are cash rich, credit poor, are people who just haven't had the ability to get their credit score to a level that the banks would want to underwrite.
ReadyLife offers a Visa credit card, or clients can use blockchain technology to make payments. Founder Ashley Bell thinks there's a market of 17.8 million customers that companies like ReadyLife can propel to homeownership.
We think that we can decrease the average age of the first-time woman homeowner and minority homeowner significantly.
The company is open to all customers, but is founded and supported by Black leaders, including Martin Luther King Jr.'s daughter, Bernice. Bell hopes that this will help build trust among skeptical Black customers.
It doesn't help that there's some big bank with some big headline every couple of months saying they denied African Americans the right to credit or to own a home.
It's too early to see if ReadyLife's model is successful, but Bell says he sees a positive response from the industry.
Everybody's headed in this direction. We're just going directly to it.
He knows it will take time to help borrowers build their credit profile, but he thinks some customers can be attractive borrowers in less than a year. And by then, he hopes home buying will be more affordable.
And we think that we'll peak at the right time when the market's coming back.
You can learn all about ReadyLife in this month's issue of NMP Magazine, available now at nmpmag.com. For the Mortgage News Network, I'm Mike Savino.
Thanks, Mike. You can also hear our conversation with Bell on The Principal, the Mortgage News Network's daily podcast, available wherever you get your podcasts. Coming up, a federal court orders extra pay for some originators in California.
Don't miss the largest regional mortgage show in the nation. The New England Mortgage Expo returns to Mohegan Sun in Connecticut, January 12th and 13th. See us at www.nemortgageexpo.com. Start your year with the best connections in the industry. Dozens of sessions, scores of exhibitors. It's where success is written every hour. www.nemortgageexpo.com.
Some MLOs in California could see some extra pay this holiday season, just not in the form of a Christmas bonus. A panel of federal judges ruled that PNC Bank improperly docked California originators' pay for their breaks, violating state law. PNC paid the originator's salary and incentives, but they only received incentives if they reached certain thresholds. When PNC calculates incentive pay, it deducts regular pay from any earned credits for those commissions. The only problem? Those originators did not clock out for rest periods. If originators weren't meeting sales thresholds, deficits were carried over and they would be docked pay the following month. A lower court ruled that violates California's labor laws. The Ninth Circuit Court of Appeals agreed this week and upheld a decision from the Northern District of California. In other news, housing supply is finally starting to tick up as buyers and sellers continue their stalemate. New listings fell by more than 20%, but the total number of homes for sale increased 15% from last year. This means more homes are sitting on the market as prospective buyers stay on the sidelines, waiting for mortgage rates and home prices to fall. But the stalemate may not last as mortgage rates fall from their November peak. Redfin's Homebuyer Demand Index rebounded 5% from a week earlier. We'll be right back with what else is interesting today. Welcome back. Here's what else is interesting today. Freddie Mac reported that mortgage rates decreased for the fourth consecutive week. They say it's due to increasing concerns over lackluster economic growth. Over the last 4 weeks, mortgage rates have declined 3/4 of a point, the largest decline since 2008. However, while the decline in rates has been large, and while real estate websites like Redfin are seeing more activity, homebuyer sentiment remains low, with no major positive reaction in purchase demand to these lower rates. For more on these and all of today's top stories, go to mortgagenewsnetwork.com.